I'm Dennis Tubbergen. You are listening to the Retirement Lifestyle Advocates radio program. Glad you decided to listen in today. Hey, joining me on today's program is returning guest Dr. Charles Nenner. Many of you longtime listeners will recognize Dr. Nenner as a very bright market tactician. And for those of you that have IRAs and 401ks in which you're investing in stocks or bonds or stock funds and bond funds, he has a very interesting forecast that you'll want to stay tuned for. So again, that's in segments 2 and 3 of today's program. I'm making available a special report this month that is a bit of a different topic for us. The report is titled, The Changing Face of Long-Term Medical Care. The report talks about the cost of medical care, who pays for such care, and gives you, most importantly, some alternative strategies to consider to protect yourself from this expense. And those of you that request the report this month will also get a copy of my best-selling book titled Revenue Sourcing, a retirement planning strategy for the post-pandemic economy. There's also some other bonus information that we'll be glad to send you. To get the report, the book, and the bonus information, all you need to do is visit the website, requestyourreport.com. The website, again, is requestyourreport.com. And if you let me know your name and where to mail all this information, I would be very glad to do so at no cost and with no further obligation. So again, the website is requestyourreport.com. Well, for those of you that maybe are of the opinion that bonds are a safe place to invest, that you can't lose money in bonds, certainly 2022 has been a bit of a wake-up call. Now, as I'll discuss with Dr. Nenner in the next segment, bonds have been in a 40-year bull market. Now, here in this segment, I want to talk to you a bit about U.S. government bonds. And for those of you maybe that don't know the first thing about bonds, a bond is simply a loan that you make to an entity. So in the case of U.S. government bonds, you're loaning the U.S. government money, in this case, to fund an operating deficit. In the case of a corporate bond, you're loaning a company money, perhaps to build a new manufacturing plant or a new tower of some type. And when bonds are issued, typically the interest rate that the investor is paid on the bond is commensurate with the risk that that investor is taking. For example, if you were to go to a corporation that had a AAA credit rating, you would get a much lower interest rate than if you went to a startup corporation and loaned that startup money. In order for the startup to interest investors in loaning them money or buying the bonds that they issue, they mean, again, the same thing, they would have to put into place a much higher interest rate to attract those investors to compensate them for the risk. Now, the Federal Reserve has really turned this bond market over the past 10 years into a bit of an artificial market. See, the Fed, through its quantitative easing or currency creation program, and I've talked about that in detail, I talk about it just about every week here on the program. The Fed is creating currency, and with that newly created currency, they are going to banks, and they're buying from those banks government bonds, government securities, and mortgage-backed securities. So the banks are buying the debt or the bonds from the government. The Fed is buying the bonds from the banks using newly created currency. So this has been an environment where interest rates have been held very low. Now, if you take a look at what happened to bonds earlier this year, I mean, we're as I record this, we're 11 days into the new year. Bonds have gotten absolutely hammered this year simply because the markets are believing that the Fed is going to raise interest rates and they're going to taper. And they believe this because of the most recent minutes released by the Fed. Now, Jim Bianco had a really interesting tweet thread on bond yields, and I want to share with you just some facts. And Jim starts his commentary by saying, in some respects, what happened in bond markets last week was epic, something we might be talking about for many years. Now, Bianco says when you're discussing bond market moves, it's his belief that the best metric, the best measuring stick, if you will, is total return. Total return includes price change and level of yields. Now, the 30-year data goes all the way back to 1973. That's 49 years ago. And the first week of 2022, when you look at the 30-year long bond, it was the worst calendar week total return in the entire 49-year history. The long bond lost 9.35% in a week. Now, Bianco said that if this was a year, a 9.35% total return loss would be the fifth worst year ever. But we're not talking about a year, we're talking about a week. We're talking about extreme volatility. Now, one of the reasons I bring this up on today's program is that many people are of the opinion that you can't lose money in bonds. And that's because we've had a 40-year bond bull market. I mean, if you go all the way back to 1981, when then Federal Reserve Chair Paul Volcker raised interest rates to 20%, since that time, interest rates have been declining for almost the entire time. And as interest rates decline, that means bonds are appreciating in value. So we have had a 40-year bull market in bonds. So to see the long bond lose 9.35% in 1 week is an extreme departure from what the trend has been. Now, the 10-year U.S. Treasury note also had a terrible week. It finished its worst week in 42 years. It had a total return loss, according to Bianco, of 4.24%. Only February 1980 saw a bigger loss for a calendar week, and that happens to be when Volcker raised interest rates to 20% plus. The calendar week total return for the Bloomberg 10 Plus Tips Index was a negative 6.09%. Now, this is the third worst week ever for this bond index. Now, the 2 weeks that were worse, one was the week of March 13 of 2020. That was at the peak of COVID panic Fed buying of bonds to the tune of $100 billion a day. And the other week was October 10 of 2008 when Lehman failed. However, the first week of 2022 was the third worst week for this index. Now, Bianco asks a really good question. He said, why was last week so epic? And he answers his own question by saying, I believe the whole bond market finally realized that easy money is over and quantitative tightening is coming. What's quantitative tightening? Well, quantitative easing is the process of the Fed creating money to buy assets from banks to add to their balance sheet. Quantitative tightening is the opposite. They sell those assets. Now, in the last segment of today's program, I'm going to spend some time talking about what that might mean for your IRA and your 401k. But before I go to the break and come back after the break with Dr. Charles Nenner, if you're just joining me, let me remind you that we have a brand new report this month titled The Changing Face of Long-Term Medical Care. The report talks about the cost of long-term medical care, it talks about who pays for long-term medical care, and it talks about alternative strategies to protect yourself. If you request the report by going to requestyourreport.com, I'll be glad to include some bonus information, including my best-selling revenue sourcing book from 2020. That book contains a retirement planning strategy for the post-pandemic economy. So again, requestyourreport.com. Requestyourreport.com is the website. Let us know where to mail all this information. We'll be very glad to do so at no cost and with no further obligation. I'll be back after these words with Dr. Charles Nenner. Welcome back to Retirement Lifestyle Advocates Radio. I'm Dennis Tubbergen, your host. I have the pleasure today of chatting with Dr. Charles Nenner of the Charles Nenner Research Center. You can check out his work at charlesnenner.com. Dr. Nenner, welcome back to the program.
It's great to be back, especially in these difficult market times.
Yeah, so Dr. Nenner, for our new listeners, and our audience is growing all the time, for our new listeners that maybe aren't familiar with your background and the kind of work you do, can you fill them in briefly, please?
Well, briefly, it's based on the fact that there's no at-random movement in nature and also in financial markets. So I developed a neural network that tells you in different markets, that goes from natural gas to crude oil to S&P to bonds to Bitcoin. We do very nicely. We tell exactly which day is going to top, which day is going to bottom, also longer term, and what is the level where a move is going to. And so we don't believe that the move starts and it just waits for a news item to come out in order to make it top, but we can calculate the top in advance. And I've been doing this, for 30, 40 years. I did it for Goldman Sachs for a long time. Being in charge of the prop traders, the money that Goldman Sachs made themselves. And since 2000, I have my own firm, and I try to help people not to lose their money, which sounds a bit awkward lately. But like I tell the people, I'm Dutch, and the Dutch says, how can I not lose money? And the American says, how can I make money? And we're really now in a time that we have to watch not to lose money.
Well, I have a lot of Dutch in my heritage, so I can certainly identify with that statement about the Dutch. So, Dr. Nenner, let's talk a little bit about the current state of the world economy. Seems like a lot of these central bank policies have really exacerbated inflation. What would be your view or your perspective on the overall health of the world economy and what inflation is going to look like as we enter 2022?
Well, I have a long-term chart that I probably publish next week of the yields of the last, I think, 300 years in the United States. And it shows me that there's a whole new up move already in place. Yields will go much higher. It can get back to the problem of the 80s. And inflation soon could go to 11, 12%, which is a big problem for people who are still holding their bonds. Now, the economy still looks reasonable for the coming year. And I remember my father who tried to make money in stocks. He never got it because the economy is good and the market goes down. That's because the market anticipates. And the stocks now become more expensive because you compare it to the real interest rates, which are like minus 6, 7%, and then suddenly stocks are expensive. And the other thing I try to get across all the time is that the people who joined me in buying the low in February after the crisis, 08, well, it's 09 already, for that long time ago, were insiders who understood that after so many years, the economy is going to do great, and then it's time to sell. It's contrary the feeling that everybody has because the small investor thinks I should sell when things are bad and I should buy when things are good. But it's actually the opposite because the market looks ahead of a year and a half. And I always say people don't listen to the news because the market is going to do what is based on what happens in a year and a half. And if you don't know it, then certainly the news from today is not going to help you. So the insiders have been selling, as I've been proven 2 weeks ago in a big piece that I wrote for my subscribers, and I showed them that a lot of stocks already in the bear market, and I showed them that 1/3 of the S&P is only supported by 1% of the stocks. So slowly, under this guise of keeping the index making new highs, the insiders were selling, and they continue to sell.
Well, to the point you just made, Dr. Nenner, I read an article, talked about it with on another broadcast that I did, that the leadership in stocks has been very narrow. For example, I think it was 40% of all NASDAQ stocks have declined 50% for their highs, and any rise in what we've
That's
seen
correct.
in the NASDAQ index is coming from 5 stocks. So it seems like across the board, this leadership is narrowing. So I know you were out of stocks as of a couple of weeks ago. So what's your forecast for stocks moving ahead here? And comment on that leadership, if you could, please.
Well, the leadership was actually five stocks that were like Apple, Google, Alpha, Nvidia, that are totally overpriced, Microsoft totally overpriced, and they were keeping the Nasdaq going. Like you said, I didn't mention the 50% being in a bear market because I also saw that. And I'm afraid to make a mistake because it's such a strong statement, but it seems to be correct also when you mention it. So a lot of stocks are in a bear market already, and those 4 or 5 stocks keep the Nasdaq or kept the Nasdaq going, but they were totally overpriced. So that's one of the reasons why now we see a big sell-off in tech stocks. Take the markets with them. The problem is that. And I know that really from a lot of investors is that people are afraid to miss 44% on the upside and don't care about 30-40% on the downside. So whenever it goes up, they're still conditioned to buy the dips, and it's not going to end well. So my idea for people as stocks is there could be a short-term bounce into the third week of January based on cycles, but you really want to lighten up on your position, because otherwise you get the same situation as in the bond market. I think we saw the bonds, the U.S. bonds, 30-year around 190. Today they're around 155, and you don't get your money back. And it's better to watch our cycles. So say the markets are topping, the situation is dangerous, and save your money, save your assets.
So, Dr. Nenner, do you have a forecast for where stocks ultimately go based on your cycles research?
Well, not only on the base cycle research. I think the first up is going to be around 18,000 for the Dow.
Wow.
And
so 50% down.
Could get worse also. Yeah, at least it could get worse also. It's a major top. If people like to sign up, which they can get for free for 4 weeks, maybe they can see what we sent out last Sunday. Is very convincing, and it showed them that at least they have the same situation as happened in 2007 at the high.
So, and again, the website for the listeners that want to check that out, it's charlesnenner.com. That's charlesnenner.com. So, Dr. Nenner, it's hard to imagine, given the current fiscal state, and you know, most of my listeners are in the United States, although we have a smattering around the world. It's hard to imagine interest rates going higher given the current state of not only U.S. finances, but the amount of private sector debt that exists. It just suggests that there's going to have to be a deflationary collapse here, because not all this debt is going to be paid, and certainly not at higher interest rates. So give me your comment.
Well, I published research that was done on the virus situation. And I showed them that in 1518, I know in front of me, I think it was smallpox epidemic, and then in 1618 the same thing, and then in 1718 it was measles, and in 1818 it was cholera, and 1918 we all know how bad it was, and now it's the virus that kills people, and it's exactly 100 years apart. And don't ask me how to explain it, but what I mentioned over there is that a few years before the 100 years, you would have no idea that it's going to be an epidemic. So we don't really know what's going on, why it's going on. The only thing that my research deals with is what's going to happen and when it's going to happen. And the rest, I'm not better than other people that publish in the media, and I don't think they have any idea why things happen the way they happen. The market starts selling off because the Federal Reserve had these comments, I think last Wednesday. Well, that's incorrect, because as you say, half of the stocks were already in bear market territory, which means is The people who know what's going on don't wait for the Fed to say something. Only the people who don't know anything and don't watch analysis, they react on the Fed, and then it's too late. So I really don't know what we can expect, but this is a bear market for bonds. I'm talking long term of at least 30 years.
Wow, so you're expecting interest rates from this point to rise for 30, and give the listeners some idea as to where you think interest rates ultimately end up. Do we see a repeat of what we saw in the early 80s?
Yeah, that's the same cycle. So I think it's a repeat of the early 80s. I just want, because it sounds so strange and we don't know what's going on, I want to give an example about the stock market. The stock market is the same strange situation. The stock market, if a year ends on a 7, you have a major sell-off. Now, this was in 1907, 17. 1929 was 2 years late. That's why it had such a crash, because it has to come down in the cycle low. And then it was 37, 47, 57, 67, 77, 87. Everybody knows 97, 98. Everybody knows there was the crisis in Russia, whatever, with the currencies. Then we had 2007. In 2017, 18, there was a sell-off. We don't know what is going on over here, but it's very helpful if you know that it's going to happen. And that's what my work does. I try sometimes to explain is that I'm trained as a medical doctor, and if the pharmacy says you have to give these people the red pill, I give them the red pill if I don't know how the red pill works. The problem with small investors is that they say, as long as I don't understand it, I'm not going to use the research. That's cost a lot of money. So I don't really can answer your question because I don't really know. I know what's going to happen, but I don't know really why.
Well, I'm chatting today with Dr. Charles Nenner. Again, his website is charlesnenner.com. He is gracious enough to offer his work for 4 weeks for free, and I encourage the listeners to check that out. Dr. Nenner, and we have time for one more question in this segment. Since most people invest in stocks and bonds, what I've just heard you say in this segment is that you're bearish on both stocks and bonds. So that really is bad news for someone managing assets for retirement the traditional way. Do you see any markets moving ahead that your cycles say will be bull markets?
Well, we're waiting for the gold and silver market to take off. Still a bit early, but we're going into bull market. And the stocks that we work with, because we follow the crude oil and the natural gas. Now, the crude oil we work with USO, and UNG is what we work with natural gas. And those stocks go according to the commodities. Those are commodities that follow soybeans. So if you want to make money, you just have to look for somewhere else. The problem is that most investors that I use to make money in a certain asset only want to make the money or make the money back in that asset. And then what they say is, well, I don't know about crude oil. And then sometimes says, well, what do you know about stock markets? You also don't know. It's the same thing. So we make a lot of money in other sectors, and we stay away from the losing sectors.
Well, my guest today is Dr. Charles Nenner. His website is charlesnenner.com. I would encourage you to check it out. I'll continue my conversation with Dr. Nenner when RLA Radio returns. Stay with us. I'm Dennis Tubbergen. You are listening to RLA Radio. I have the pleasure of chatting today with Dr. Charles Nenner. Dr. Nenner's website is charlesnenner.com. He's graciously offered to give the listeners of the program today 4 weeks of his research for free. Again, the website to check that out and claim that free research is charlesnenner.com. So, Dr. Nenner, there is a lot going on in the now mainstream media as far as covering cryptocurrencies, Bitcoin. There's been some press that China, South Korea, and Russia are now clamping down on cryptos. Tell me a little bit about how you see cryptos near term.
Well, first for cryptos, it's the easiest thing to analyze, especially with cycles, because let's say you analyze IBM, the cycles work, but there could be a small interruption because IBM could come out with some news or numbers, which almost doesn't happen in Bitcoin, and we do Ethereum, Bitcoin, and there's no fundamentals on there. There's just rumors. It's full of idiots where Katie, I forgot the last name, got a place in a board of Bitcoin and says the Bitcoin goes to 100,000. And then, people listen. And if I ask the people, okay, you don't want to explain how she gets there, because I'm sure she doesn't know how she gets there. So we went out of Bitcoin around 69,000 when cycles stopped. And cycles are still down. And if it holds this week above 38,000, then we might go long again for a bounce. Ethereum looks worse. The cycles are really down for Ethereum. And for now, the party is over. We even have intraday updates on Bitcoin and Ethereum because it is so volatile. So subscribers get them mostly once a day. After a couple of hours of trading, we tell them what time, because we also have hourly cycles, what time the Bitcoin is going to bottom and what level is going to bottom and where it goes. It's very easy. It's very easy to analyze these two things. But for the moment, Ethereum is in a bad situation because of the cycles, and Bitcoin just has to hold above 38,000 to make another try to get higher. But it's not going very high. It's just going to make a bounce.
So do you have any long-term forecast for, say, Bitcoin and Ethereum?
Well, that's a bit problematic because in order to make a long-term forecast, you need long-term cycles. In order to make long-term cycles, you need data of at least 20 years or so, and it doesn't trade that long. So it will take a couple of years until I can make weekly and monthly cycles and come with a long-term forecast.
Okay, well, let's talk a little bit about metals, if we could, gold and silver, and we can talk about each market. Seems like with the inflation that is now here, in fact, Jerome Powell changed his language describing inflation from transitory to persistent. It seems that gold and silver probably should have taken off more than they have. We've seen a little bit of a bump here, but nothing significant. How do you see gold and silver moving ahead through 2022?
Well, you're right about gold and silver, but I have written about this. Maybe you remember, I don't know how old you are, Tom and Jerry. You remember those, the cat and the mouse?
I remember the cat and the mouse.
Okay, so the cat is chasing the mouse, and they get to a cliff, and the mouse stops, and then the cat goes over the cliff and continue to walk until he looks down and says, oh, there's nothing here to walk on, and then he only falls down. So the news is there, but we don't realize it yet. So that's why the cycles come in. When the cycles are turning up, it's then that people start realizing it. And as long as the cycles don't turn up, the news could be there, but they don't realize it, so we don't have a bull market.
So do you see gold and silver going bullish this year?
Yeah, definitely. Definitely.
So let's break them down.
I like people to look at our forecast because I don't want them to buy now and it goes lower for another 2 months and then they have a loss and they sell off and then it takes off. It's a matter of timing. This gold and silver has been in a trading range and it's very difficult to trade this, and you just have to wait for a major low, which is going to come in a month or 2 months, and then gold could go much higher. Maybe because you said, what should people do? There's an idea to get into gold stocks because they have a nice dividend, much more than you get in the bank, and then you can just wait for the move starting to go up.
So are you more bullish on gold or silver as we move ahead through this year?
That doesn't make much difference. That's a good question. I don't think it makes much difference, and that's one of the reasons why I can't answer you. I'm happy if we're right on silver and we're right on gold going up, and if one goes a little bit more than the other one, that's not so important.
So what kind of work, Dr. Nenner, do you do with currencies, and do you have a forecast for the U.S. dollar?
Yeah. Longer term, the U.S. dollar is bullish. we could see some weakness for a week or so now. It's not important. I have a chart going back to the 1900s. Cycle is very clear, and we should continue in a bull market for the dollar.
So let's talk a bit about commodities, if we could. Do you see commodities like industrial metals and agricultural commodities? I understand those are two different things, but do you see those two classes also being bullish moving ahead, given current Fed policy?
Yeah, we are long-term long already in corn and in beans and wheat. There's some short-term cycles at bottom in a week or 10 days. I don't have it exactly in my head. And they should go much higher, especially soybeans. And it's going to lead to a lot of inflation. If you look at the Goldman Sachs Commodity Index, it really took off, and it could go much higher. This is really something that people have to think about, what to do with the money and how to save their assets.
So just to kind of summarize, Dr. Nenner, you correct me if I'm wrong, it seems that moving ahead, traditional investing, the stock and bond investing and the old Wall Street advice, the older you are, put more of your money in bonds, it seems that is really, based on your cycles, that's going to set many people up to fail financially. And from what I've gathered from this interview, you really need to be looking at alternative asset classes. Is that fair?
Well, we had to rally in bonds almost 40 years. So people didn't realize bonds can also go down. And again, I wrote about it 2 years ago. I said, if you think that that inflation stays at 1.5%, I think you're wrong. But then stay in bonds if you want to take the gamble. But it doesn't seem very logical, because even if you don't believe in my cycle work, this is not going to stay forever. And again, once bonds sell off, you can't get it back. And again, if you have a stock, Apple just mentioned something, and it sells off at the market, and in 1 or 2 years it makes either bigger profits, then the stock goes back up. But that's not the situation with bonds. And like you said, the biggest amount of money is in bonds, not in stocks. So I think the consumers are going to be in trouble soon, especially the younger ones, because what I see around me is that they're all in Bitcoin and in Ethereum, and they're going to lose their shirt if they don't know what they're doing. So a lot is going to change.
So at what point do your cycles show that, look, just going back to stocks again for a minute, at what point do you think we ultimately get a bottom? And, if we're getting a big decline, I think you said the first stop on the Dow might be 18,000. That's already
right.
A big drop. But how low does it go? And when do you think it might get there?
Well, I think it's going to be negative for the whole year. But again, I think you could have a bounce until the 30th of January, so there's another chance to lighten up a little bit. And I don't listen to people who say you be in it for the long term, because like I sometimes give an example, if you go to the market to buy oranges, and the oranges are $2, and you say next week they're $1, you buy them only next week when they're $1. So why should you buy them when they're $2? So why should you just first lose a lot of money if the downturn is so simple? And then, it goes down 40, 50%. And then you have to struggle to make back 100%. It goes down 50%. You have to make them 100% in order to break even.
So, Dr. Nenner, we have time for just one more question here in this segment. You had mentioned in the first segment that you saw inflation going up to double what it is now. Can you comment on how you've reached that conclusion?
Well, it's the same thing that if let's say the S&P goes up with a certain momentum, I sometimes explain, if you shoot a bullet in the air, people who know the physics know that it has a certain amount of time until it turns down, and you can calculate with the momentum how high the bullet will go until it starts going down. The same thing with markets. If the inflation goes up in a certain period fast with a certain percentage, you know how it's going to continue. So you just project, like you project an upside price target for the S&P, you project an upside target for the inflation. It's all mathematics.
Well, my guest today has been Dr. Charles Nenner. He has been gracious enough to offer 4 weeks of his research for free to our listeners. If you'd like to claim that research, you can go to charlesnenner.com, and Nenner is spelled Nenner. That's charlesnenner.com. And Dr. Nenner, always appreciate your perspective, and I've really enjoyed your work. Love to have you back down the road, and thank you for joining us today.
I'm sorry I had to be a bit negative, but it's better to, better safe to, how do you say it in English? I forgot.
Better safe than sorry.
We have to be safe. Okay.
Better
yes,
safe than sorry. Yeah. Well, always a pleasure to catch up with you, and again, would love to have you back down the road, and I'd encourage the listeners to check out your work at charlesnenner.com. So thank you for joining us. We will return after these words.
Well,
You are listening to the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen, and thanks again to Dr. Charles Nenner for joining us on today's program. You know, as I talked about in the first segment, and as I talked about with Dr. Nenner, bonds seem to be reversing course at this point after a 40-year bull market. Bonds, as 2022 got started, performed dismally, as I wrote about in my most recent Portfolio Watch weekly newsletter. And incidentally, if you're not yet a subscriber to the Portfolio Watch newsletter, there's no reason not to be. It is a free weekly newsletter. All you have to do is visit retirementlifestyleadvocates.com and sign up for the free newsletter, and it will be emailed to you every Monday at 5 p.m. So when the recent Federal Reserve minutes were released, it became pretty obvious that the Fed is making what the markets perceive to be a very valid threat to take away the punch bowl, to take away the currency creation. And the markets, especially the bond market, but the stock market as well, are reacting. Now, why are markets reacting? Well, for the first thing, higher interest rates will be detrimental to an economy that's already fragile. I mean, you only have to look at the most recent jobs report to see that the economy remains weak. I'm going to give you a quote from a Yahoo Finance article. Non-farm unemployment grew by 199,000 in December, the U.S. Labor Department announced Friday, a disappointing result that fell well short of expectations for the month. Analysts were expecting job creation at twice that level. And incidentally, as the unemployment rate goes down, it's really not because a lot more jobs are being created. It's because the workforce is shrinking. People are dropping out of the workforce. So the unemployment rate is dropping for exactly the wrong reason. Now, I've talked about this in the past here, but you know the Fed really has two choices, and they're both bad. One, if they follow through on the taper, if they quit currency creation, if they start hiking interest rates, that will be bad for the economy and the financial markets. On the other hand, if they continue currency creation and continue these easy money policies, that will be bad for the U.S. dollar. There's not a good outcome here, which is what the revenue sourcing book talks about. And it gives you some strategies to consider to help you navigate this environment, because we don't know exactly what Fed policy is going to be. My opinion is they will start to tighten, the markets will react negatively, and the Fed will reverse course. But that's my opinion. If you don't yet have a copy of the revenue sourcing book, you'll get it when you request this month's free report. All you need to do to get it is go to requestyourreport.com. We'll be glad to send you the book, the report, and all the bonus information. Now, should the Fed start to engage in easy money policies again, At a certain point, rather than helping the financial markets, inflation will hurt them. Now, Steve Forbes had some interesting comments last week, and I quote, "This could well be the year that inflation starts to smack the stock market. The current episode of What's Ahead explains why. Investors need to understand there are two kinds of inflation: monetary inflation and non-monetary inflation. Last year, most of the increases in prices came from pandemic disruptions made worse by Biden administration blunders. This is non-monetary inflation. The other type of inflation comes from the Federal Reserve printing too much money. Our central bank has been using a certain gimmick, reverse repurchase agreements on an unprecedented scale to keep this mountain of money from cascading into the economy. But these kinds of ploys always end badly. Moreover, the Fed has announced that come spring it will no longer be adding to its holdings in government bonds, which means higher interest rates than even the Fed anticipates. And that's bad news for the economy and the stock market." Mr. Forbes touches on the fact that the Fed has two choices, and they are both bad. Should they continue with the tightening, that will be bad news for financial markets and for the U.S. economy. Now, recent guest here on the program, Alistair McLeod, also commented on this. He said, "The establishment, including the state, central banks, and most investors, are thoroughly Keynesian." Well, Keynesian economists simply believe that you can create currency to take up the slack in the economy, and you can control inflation on the back end through different means. Now, Alistair said that this belief in Keynesian economics is about to change. He says, and I quote, "The world of continual Keynesian stimulus is coming to its inevitable end, with prices rising beyond the authorities' control." In other words, it's going to get away from them. Being blinded by neo-Keynesian beliefs, no one is prepared for it. Now, he wrote an article and talked about the fact that in the UK, the current rate of monetary inflation that we have in the United States actually occurred for only half the time that it has here, just for 1 year, and gilt coupons went over 15%. Now, how does that compare to the money creation that we have seen? Well, since February of 2020, the M2 money supply has increased from 15.4 trillion to 21.4 trillion. That's about 39% increase in the money supply in just 20 months. That's an average annualized inflation rate of 23.2%, and from 2008 to 2021, that inflationary increase was 175%. Mr. McLeod, in his article, points out that if the consumer price index measure of inflation is the relevant measure, if that's the measure you want to use, then its current indicated rate of price inflation at 6.8% is only the beginning of upward pressure on prices. Alistair points out that markets are ignoring this reality for now. They're hoping the Fed is still in control and can be believed. He said, "We can soon be sure that it will become apparent that the monetary authorities have a major problem on their hands, which will no longer be satisfied by jaw alone. Interest rates will then be destined for significantly higher levels, not because there is demand for capital against a background of limited savings supply, but because anyone holding dollars will require compensation for retaining them." And I believe we may be seeing that, the beginning of that, presently. So if you're unsure as to what to do with your IRA or your 401k, I would invite you to get some free resources. If you request our report this month, you'll get some bonus information that addresses these topics, as well as a copy of the best-selling revenue sourcing book, All you need to do is go to requestyourreport.com. Let us know where to mail your information, and we'll be very glad to do that. Again, the website, requestyourreport.com. That's all the time I have for this week. I'll be back again next week.